Hello everyone, this is Jennifer. In this video we're going to look into the non-banking financial institutions. So what is a non-banking financial institution? It is any institution which is carrying on the business of financial institution and includes also the business of non-financial institution. So basically what do? They raise funds from the public directly or indirectly, lend these funds to their ultimate spenders. So as banking institutions were found insufficient to meet the ever increasing demand of various sectors like the corporate sectors, the non-banking financial institution basically came in order to help the efforts of these banking institutions. So non-banking institutions play a very important role in channelizing the scarce financial resources and also for the economic development of the country. So what is the role of financial institutions? So financial institutions basically provide means and mechanism for transferring resources from those who have excess of income over expenditure to those who can make productive use of the same. So the commercial banks and investment institutions mobilize savings of people and channelize them into productive uses. So what is a financial institution? It's an institution who basically take the savings from the people and channelize them to the productive uses, like giving them for the corporate sectors or infrastructure facilities or etc., which ultimately help in the economic development of the country. So the basically institution that help in economic development in the following ways. First one, providing funds. So the underdeveloped countries have a very low level of capital formation, due to which the low income people who are not able to save sufficient funds are needed for setting up new units and also for expansion, diversification, etc., of their existing units. So these people who have capability of starting a business but do not have required funds can approach the financial institution for funds. They basically provide funds for any startups, for any existing companies, etc. And also financial institutions have large investable funds which are to be used for productive purposes. Second one, infrastructural facilities. So the economic development of country basically is linked to infrastructure facilities to a large extent. So we need roads, water, sewage, communication facilities, electricities, technology oriented. So we need to keep upgrading to the technology also at times. So we need money for everything. So financial institutions prepare the investment policies by keeping the national priorities in mind. So they invest in those areas which can help in the ultimate development of the country. The next one, promotional activities. So and as an entrepreneur faces many problems while setting up a new unit, one has to undertake the feasibility report, prepare project report, complete registration formalities, get approval from various agencies, etc. And after doing all this, some people are not able to undertake this exercise and some do not even have initiative. So financial institutions have expertise and manpower resources for taking up this exercise of starting a new unit. So the promotion role of financial institution is to help in increasing the development of the country. So basically help in promotional activities and also coming up with new startup units, promoting them, etc. The next one is development of backward areas. So some areas remain neglected because facilities need for setting up new units are not available there. So at this time, the industrial units in these areas improve basic amenities and create employment opportunities. These measures will ultimately help in increasing the economic development of the country. So in order to help the development of backward areas, financial institutions provide special assistance to entrepreneurs for setting up new units in these areas. So the next one is plant development. So financial institutions help in plant development of the economy. Different institutions earmark their space of activity so that every business activity is helped. Some institutions like SIDBI, SFCI especially help small sector, while IFCI and SIDC financial large sector or extend loans having a certain limit. So basically, they give preference to those industrial activities which have been specified in industrial policy statement and in 5-year plans. The next one is accelerating industrialization. So the economic development of the country is basically related to the industrialization. So setting up new units, you need a lot of things. So one among them is basically finance, which has been ultimately helped by the financial institution, or setting up institutions, setting up new units in backward areas also help in industrialization and economic development. So, since 1947, financial institutions have played a very major role in accelerating the pace of industrialization. So, the country has progressed in almost all areas of economic development. The next one is employment generation. So, financial institutions have helped both direct and indirect employment generation. They have employed many persons to man their office. Besides office staff, institution need the service of experts which help them in financing, lending, etc. So they basically create employment opportunities by financing new and existing industrial units. They also help in creating employment opportunities in backward areas by encouraging and setting up new units in those areas. So, moving on to different kinds of financial institutions and looking into their functions. So, financial institutions basically are categorized into two categories. One is the banking institutions and then non-banking institutions. Under the non-banking institutions, there is organized institutions and unorganized institutions. Under the organized institutions, we have different kinds of banks. One is the All India Development Banks like the IDBI, IFCI, ICICI, IDFC, SIDBI, IRCI, and Exim Bank, NABARD, investigation institutions like the LIC, UTI, etc., and GIC. So the first one we are going to look into is the IFCI. That is nothing but Industrial Finance Corporation of India. Basically, this was established in the year 1948 under the IFC Act 1948. So the main objective of this corporation is basically to provide medium and long term credit to industrial concerns. So since July 1st, 1993, this corporation has been converted into a company. It has been given the status of a limited company with the name Industrial Finance Corporation of India Limited. So what are the functions of IFCI? The functions of IFCI are as follows, which can broadly be classified into finance assistant, promotional activities, and financial services. So what are the finance assistance that the IFCI gives? So they grant loans and advances to subscribing to debentures of Indian concerns repayable within 25 years. They underwrite the issue of industrial securities. So basically, they help in marketing the securities or selling the securities of the industries like the shares, bonds, debentures, etc. They also subscribe to these shares directly of public limited companies. They guarantee of loans raised by the industrial concern, and they also act as a agent for the central government or the World Bank. So these are the financial assistance. Moving on to promotional activities, the IFCI has been playing a very important role as a financial institutions in providing financial assistance to the industrial concerns. However, no less than playing a promotional activity role also. The corporation has discovered the opportunities for promoting the new enterprises or for developing the enterprises which are in the backward areas, or for developing the small and medium scale entrepreneurs by providing them guidance and specialized agencies in identifying their projects, new startups, etc., which ultimately help in the economic development of the country. The third one, financial services. So financial services provided by IFCI includes corporate counseling for financial reconstruction, then assistance in settlement of terms and conditions if they have a foreign collaboration with other countries, Then revival of sick units. For example, if the units are getting losses and they're trying to liquidate, at that time providing them financial assistance or promotional activity assistance, and financing of risk projects, which wherein the idea is very huge and risky, but it can be successful also at times. So moving on to our next type of institution, which is IDBI. So the Industrial Development Bank of India was established under the Industrial Development Bank of India Act 1964 as a wholly owned subsidiary of the Reserve Bank of India. So the ownership of IDBI is transferred to the central government from 1976. So what is the main objective of setting up IDBI is to coordinate the activities of other financial institutions and also to act as reservoir on which the financial institution can draw. So it basically provides finance assistance to industrial units. So the various functions of IDBI are as follows. So the first one is to coordinate the activities of other institutions providing term loan finance to industry. The next one is to provide refinance to financial institutions, granting medium and long term loans, and also to provide refinance to scheduled banks or cooperative banks. So refinance is nothing but it is the process wherein one loan is replaced by another loan. So basically refinancing your mortgage basically means that you're trading in your old mortgage for a new one and possibly for a new finance or a new balance. So or it can also mean refinance means just like revising the terms of an existing loan, interest rate, payment schedules, timing of repayment, etc. So basically provide refinance to scheduled banks, refinance for export credits granted by banks and finance institutions. They provide technical and administrative assistance for promotion, management or growth of the industry. They also undertake market survey and techno-economic studies for the development of industry, and also they grant direct loans and advances to industrial concerns. So IDBI is empowered to finance all types of industrial concerns like fishing, hotel industry, mining, goods, shipping, transport, generation, etc. And also they render finance assistance to industrial concerns. IDBI operates various kinds of assistance like direct assistance scheme, loan scheme, technical development fund, then seed capital assistance scheme, then development assistance fund, then refinance industrial loan scheme, or bill rediscounting scheme. So basically they undertake and assist in, they basically render assistance. So moving on to the next institution, which is the SFC. SFC is nothing but State Finance Corporation. So SFC, scope of SFC is limited to deal with large public companies and cooperative society. So if you look into SFC, it's only dealing with large public limited companies and also cooperative society. It will not cater to all kinds of industrial enterprise spread throughout the country. Sorry, I again repeat, the scope of IFCI, Industrial Finance Corporation of India, which we studied to the prior slide, is limited only to the public limited company and cooperative society. So since IFCI does not cater to all the needs, the state came up with something called as SFCI, which is nothing but State Finance Corporation. So the SFCI came under the Act SFCA, which is State Finance Corporation Act, which was passed in the year 1951, which authorized each state and union territory to set up their own finance institution. So Punjab was the first state to set up this corporation under the Act 1953. So at present we have 18 finance corporation which are working in different states. So they are expected to play a complementary role to the IFCI. So basically providing finance just like IFCI but on a state level basis. So what are the functions of SFC? So the main functions of SFC is granting of loans or advances to Indian concerns which are repayable within a span of 20 years. So sometimes they also subscribe to the debentures of Indian concerns which are repayable within a period of 20 years, and also guarantee the loans raised by the Indian industrial concern. They underwrite the shares. Underwrite the shares means they sell the shares on behalf of the company. They act as an agent to the central government or the state government in respect of any business or the loan sanctioned to them. The next one is Exim Bank. Exim Bank is nothing but Export and Import Bank of India, so which was set up in the year January 1982, but basically they commenced their operation on 1st March 1982. It is the topmost banking institution in the field of financing foreign trade of India. It basically looks into the export finance function of the Industrial Development Bank of India. So the main functions of the bank are in the following words. Basically it has its objective like the bank may grant in or outside Indian loans and advances by itself or in participation with any bank or financial institution whether in India or outside India or for the purpose of export or import, and shall also function as a principal financial institution engaged in financing of the export and import in such a manner as it is deemed to be. So basically they are dealing with export and import activities of the country. So they provide all kinds of assistance whether finance, technical, relating to import and export. They also carry out research, surveys, studies in developing the foreign trade, etc. So what are the functions of Exim Bank? So they finance the import and export in and outside India. They also finance the export and import of machinery and equipment which are bought on a lease basis. They finance the joint venture abroad. So what do you mean by joint venture? So it basically a combining two or more companies, or it is a commercial enterprise undertaking jointly, or in simple words it's a legal organization that takes form of a short-term partnership in which persons jointly undertake the transaction for a mutual profit. So two or more companies jointly get into a venture and finish the task. So financing joint ventures when it is abroad, so and underwriting stock, shares and bonds and debentures of the company which are engaged only in export and import. So moving on to our next slide, which is mutual funds. So what is a mutual fund? A mutual fund is basically an investment vehicle for investors who pool their investment savings for investing in diversified portfolio of securities with the aim of attracting yields and appreciation in their value. So basically there's a mutual fund organization who basically receive money from the shareholders and invest in different kinds of securities. So they diversify the investment in different kinds of security so that there'll be a constant profit, or there'll be at least be a recurring profit instead of loss, instead of taking high risk. So there are various types of mutual funds. So according to the ownership, mutual funds can be classified into public sector mutual fund and private sector mutual funds. So public sector mutual funds, so the UTI, which is your Unit Trust of India, has been functioning in the arena of mutual fund businesses in India since 1963 to 1964. So basically the num so these are the funds which are sponsored by the companies of the public sector like SBI mutual fund, LIC mutual fund, Can Bank mutual fund, etc. Private sector mutual fund, these funds are sponsored by the companies for the private sector. So some of the well known mutual funds are ICICI mutual funds, HDFC mutual fund, etc. So according to scheme of operation, there are three types, which is open-ended mutual funds, closed-ended mutual funds, and interval mutual funds. So open-ended mutual fund scheme means a scheme of mutual funds which offers unit of sale without specifying any duration for the limit. So these schemes do not have a fixed maturity time. Okay. So an entry to the fund is always open to the investors. Closed-ended mutual funds means any scheme of mutual fund in which the period of maturity of the scheme is specified, and also the investor can subscribe directly to the scheme only at the time of the initial scheme. The third one is interval scheme. An interval scheme is a scheme of mutual fund which is kept open for a specific interval, and after that it operates to be a closed scheme. So it is a combination of open-ended and closed-ended. So according to portfolios, mutual fund can be classified into different types. The first one is income funds. So these funds basically aim at providing maximum current return or income to the investors. So high return and capital appreciation. So the investment are made in stocks yielding high returns, and capital appreciation is of small importance. So only high returns is what is mostly concerned. The capital appreciation is not taken into much consideration. Then is growth funds. So these funds aim at providing capital appreciation in the value of investment rather than higher income. So it's just the opposite of income funds. The next one is balance funds. Balance funds spent both on common stock and preferred stock. So some part is spent on equity while the other part is spent on interest bearing. So it is combination of both income and growth, which is recurring income and also the capital appreciation. The next one is stock or equity fund. So these funds mainly invest in the stocks of the shares of the company. The next one is bond funds. So these investment ensure fixed and regular income, basically investing in the bonds of the companies or the interest bearing securities of the company. Next one is specialized funds. These funds invest in a particular type of security. The funds may specialize in securities of the company dealing in particular product, firms in a particular industry, or of certain income producing securities. The next one is leverage funds. So the primary aim of leverage funds is to maximize capital appreciation. So these funds may use even borrowed funds for buying speculative stocks which ensure a profit in the future. The next one is taxation funds. The mutual fund may be designed to suit the taxpayers. So the contributors to such funds get some concession in the income tax. The next one is money market mutual fund. So money market mutual funds means a scheme of mutual fund which has been set up with the objective of investing exclusively in the money market instruments. So the last kind is, according to location, domestic mutual fund, basically investing within the country, and offshore funds, basically investing outside the country. So the next one is advantages of mutual funds. So the various advantages of mutual funds are: first, diversification. So large number of investors have small savings with them. They can at the most buy shares of one or two companies, so diversifying your investment. Second one is expert supervision and management. So a small investor cannot be expert in portfolio management. When he invests in mutual fund, he gets the benefit of expert supervision and management. The third one is liquidity. So a peculiar advantage of a mutual fund is that investment made in the schemes can easily be converted into cash promptly. The next one is reduced risk, as mutual fund invest in large number of companies, so professionally the risk factor is reduced. The next one is tax advantage. So there are certain schemes of mutual fund which provide tax advantages, like a tax advantage mutual funds, etc. Next is low operating cost. So the mutual funds have large investable funds at their disposal and thus can avail economies of large scale and economies of large scale and also. And the next one is flexibility. So the mutual fund provide flexible investment plans to the subscribers, either if they want regular investment plans or regular dividend or capital appreciation. According to that, they can change their investment strategies. The next one is higher returns. So mutual funds are expected to provide higher returns to investors compared to other kinds of investments. Next one is investor protection. So the mutual funds are regulated and monitored by the Securities Exchange Board of India. So it is more facilitating protection to the investors and competition. So the last one that you're going to look into is the payment banks. So there are small finance banks which provide lending activities among weaker sections of the community and to get complete financial inclusion. So these small finance bank basically undertake financing activities such as accepting deposit, lending or advancing loans. So on the other hand, there is something called as payment bank. So the payment bank can offer only limited services, as their primary role is only payment remittance services and deposit services. So they basically conduct activities which is limited to demand deposit up to a certain limit, or and they cannot grant loans. So these banks can only issue debit cards but cannot issue credit cards. So only debit cards can be issued. So this is a kind of payment bank. Thank you everyone.